Stop scrolling. Close the other tabs. Because what you're witnessing right now is not another crypto correction. It's not a healthy pullback. And it's not another opportunity to buy the dip. This is the beginning of the largest capital rotation in modern financial history. A rotation so massive, so violent, and so undeniable that it's rewriting everything Wall Street thought they knew about digital assets versus physical metals. Right now, at this exact moment, Bitcoin is trading at $89,550. Silver just crossed $103 per ounce. Gold is at $4,188. And if you think those are just numbers on a screen, you're missing the story behind the story. Because while the mainstream media celebrates every Bitcoin bounce, institutional money, the smart money, the whale money, is quietly executing the greatest exodus from crypto into precious metals that markets have ever witnessed. I'm going to show you the on-chain evidence, not predictions, not theories, not hopium. I'm going to walk you through the blockchain data that proves crypto whales are dumping Bitcoin. I'm going to show you the ETF flows that confirm institutions are fleeing. And I'm going to reveal why nearly $200 billion is rotating out of digital promises and into physical reality at a speed that's about to break both markets. You're watching the end of an era, the era where code was supposed to replace atoms, where digital scarcity was supposed to beat physical scarcity, where Bitcoin was supposed to be digital gold. That narrative just died. And the capital fleeing its corpse is flooding into the one asset that cannot be printed, cannot be hacked, and cannot disappear when the power goes out. Let's start with the data that crypto maximalists don't want you to see. Let's start with what's actually happening on the blockchain itself. Because when you follow the money on chain, when you trace the actual movement of Bitcoin from wallet to wallet, exchange to exchange, the story becomes crystal clear. According to on-chain data from CryptoQuant, addresses holding between 1,000 and 10,000 Bitcoin have collectively reduced their balances by approximately 220,000 Bitcoin over the past year. That's not market noise. That's not normal repositioning. That marks the steepest decline in whale holdings since early 2023. Think about what that means. At current prices of $89,150 per Bitcoin, that's $19.7 billion worth of Bitcoin that has been systematically sold by the largest holders. These aren't retail traders panic selling on red candles. These are sophisticated entities controlling billions of dollars in crypto assets, and they're exiting. But it gets more alarming. The all exchanges whale ratio, which tracks the ratio of the top 10 inflows to total exchange inflows, has climbed to its highest level in 10 months. What does that tell you? It indicates that whales are using exchanges heavily, moving massive amounts of Bitcoin onto exchanges, which is the necessary first step before selling. They're not moving Bitcoin to cold storage. They're not holding for the long term. They're preparing to dump. And when you see whale balances declining while exchange whale activity is spiking, you're witnessing the setup for a major liquidation event. Now let me show you where this connects to silver. Because when you track where capital is going, when you follow the money leaving the crypto ecosystem, a significant portion is flowing into physical precious metals. We know this because the premium on physical silver, the extra cost you pay above spot price to actually hold metal in your hand, has exploded. 3 months ago, you could buy a silver eagle for about $3 over spot. Today, that same coin costs $12 to $15 over spot. In some markets, premiums are pushing $20. That's not supply chain disruption. That's not normal market friction. That's panic buying. That's capital fleeing digital assets and flooding into tangible wealth. But the on-chain data is just the beginning. Let me show you what's happening in the institutional market, because this is where the real earthquake is occurring. US spot Bitcoin ETFs, the flagship products that were supposed to usher in the age of mainstream institutional adoption, just experienced their worst 2-month stretch in history. The 11-spot Bitcoin ETFs cumulatively registered a net outflow of $1.09 billion in December after a much steeper $3.48 billion in November. Now that amounts to a combined 2-month redemption worth $4.57 billion, the largest since their debut in January 2024. Let that number sink in. $457 billion exited Bitcoin ETFs in just 2 months. That's not retail money. Retail doesn't move billions. That's pension funds. That's hedge funds. That's family offices. These are sophisticated allocators making calculated decisions to reduce exposure to Bitcoin. And the bleeding didn't stop in December. Between January 6th and January 8th, Bitcoin ETFs recorded over $1.1 billion in outflows, with $486.08 million on January 7th and $398.95 million on January 8th. Here's what makes this so devastating. Just days earlier, on January 2nd and 5th, these same ETFs had attracted approximately $1.2 billion in inflows as the new year began. What changed? Why did institutional money reverse so violently? Because they saw the same thing the on-chain data is screaming. Bitcoin is not behaving like digital gold. It's behaving like a high-risk speculative asset. And when speculative assets start showing cracks, institutions don't wait around to see if it recovers. They sell first and analyze later. Now contrast that with what's happening in the silver market. On January 23rd, 2026, silver traded at $103.30 per ounce. That's a new all-time high. That's 155% higher than where silver started in 2025. While Bitcoin ETFs hemorrhage billions, physical silver demand is so intense that supply chains are breaking. The US Mint, the largest sovereign mint in the world, has temporarily suspended production of American silver eagles due to supply chain disruptions. That's the diplomatic language. The reality is simpler. They cannot source enough refined silver blanks to keep up with demand. The Royal Canadian Mint has implemented allocation systems for dealers. You can no longer order the quantity you want. You get what they allow. The Perth Mint in Australia has extended delivery times to 16 weeks, 4 months, for a product that used to ship in 3 days. These aren't isolated incidents. This is a coordinated collapse of the retail silver supply chain happening at the exact same time Bitcoin whales are dumping their holdings. You don't need a PhD in economics to connect the dots. The capital is rotating. From digital promises to physical reality, from counterparty risk to sovereign wealth. Let me show you the mathematics of how this rotation works. Bitcoin currently has a market capitalization of approximately $1.77 trillion. The entire global silver market, including all silver ever mined above ground, is estimated at roughly $1.5 trillion. But here's where it gets interesting. The tradable float of silver, the amount available for immediate purchase without triggering massive price dislocations, is a tiny fraction of that total. Most silver is locked in industrial applications. Solar panels, electronics, jewelry, medical devices. It's not coming back to market. According to recent data, between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. Think about that. In 1 week, over a quarter of the available deliverable silver vanished from the exchange. Now let's do some simple math. If just 2% of the capital that exited Bitcoin ETFs in November and December, just 2% of that 4.57 billion, if that money tried to buy physical silver on the COMEX, it would overwhelm the entire registered inventory. The exchange would default. They'd be forced to settle contracts in cash instead of metal. And the moment that happens, the moment the paper market breaks from physical reality, price doesn't just rise, it teleports. We've seen this movie before. In March 2022, the nickel market on the London Metal Exchange exploded. Nickel went from $25,000 per ton to over $100,000 in hours. Why? A single entity got caught in a massive short squeeze and couldn't deliver physical metal. The exchange halted trading, canceled billions in trades, rewrote the rules overnight. Silver is setting up for the exact same dynamic. Except at this time, the shorts aren't a single mining company. The shorts are the Western banking system. And right now, with prices at all-time highs, with registered inventory at historic lows, and with Bitcoin whales rotating capital into physical metals, those shorts are trapped. But here's the critical difference between now and previous silver rallies. In 2011, when silver hit $49, there was plenty of physical metal available. COMEX had over 100 million ounces in registered inventory. Miners were producing at capacity. Most importantly, there was no competing narrative. Bitcoin didn't exist. Digital gold wasn't a thing. So, when regulators intervened, when they raised margin requirements and forced liquidation, the silver market collapsed and stayed down for nearly a decade. Today, the setup is completely different. Registered inventory is a fraction of 2011 levels. Mine production has been flat or declining. And here's the big one. There's a competing narrative. The very thing that was supposed to replace silver, Bitcoin, digital gold is failing in real time. Bitcoin is down 29% from its October 2025 peak of $126,000. Institutional money is fleeing. ETFs are in freefall. And that failure is sending a message to every allocator on the planet. Digital scarcity is not the same as physical scarcity. Code can be forked. Algorithms can be changed. Networks require electricity and the internet. But you cannot print silver. This brings us to the technical breakdown happening in Bitcoin right now, because while on-chain data shows whale selling and ETF flows confirm institutional exit, the price chart is painting an equally bearish picture. Bitcoin broke below the 50-week moving average for the first time since October 2023. For those who don't follow technical analysis, the 50-week moving average is one of the most watched indicators in crypto. It's the line that separates bull markets from bear markets. And Bitcoin didn't just break below it, it collapsed through conviction. From 97,000 on January 1st to 89,550 today. That's an 8% decline in 3 weeks. But the real danger isn't the break itself, it's where Bitcoin is headed next. According to technical analysts, if this correction continues, the next major support sits at the 200-week exponential moving average. currently around $68,000. That would represent a 24% decline from current levels. And if you think that sounds catastrophic, remember Bitcoin fell 67% in 2014, 84% in 2018, and 77% in 2022. Meanwhile, silver is doing the exact opposite. While Bitcoin breaks down through support, silver is breaking out through resistance. Silver recently hit 103.30, smashing through the psychological $100 barrier that markets watched for decades. And here's why $100 silver matters. For 45 years, from 1980 to 2025, silver was trapped below its all-time high of $50. When it finally broke above 50, it didn't pause, it didn't consolidate, it accelerated from 50 to 60 in weeks, from 60 to 70 in days, from 80 to over 100 in less than a month. This is what a parabolic rally looks like. This is what happens when decades of pent-up demand, decades of supply deficits, and decades of price suppression all unwind at once. But let me address the elephant in the room. Because I know what you're thinking. Bitcoin has survived crashes before. It bottomed at 15,000 in 2022 and rallied to 126,000 in 2025. What makes this time different? The answer is structural. In previous cycles, Bitcoin crashes were driven by over-leveraged retail traders, but the underlying demand, the long-term holders, the believers in the digital gold narrative, they never wavered. They accumulated through crashes. They held through fear. Eventually, price recovered. This time, the crash isn't being driven by over-leveraged retail. Why? Because their mandate has changed. In 2025, Bitcoin was a speculative growth asset, a bet on the future of money. But in 2026, with geopolitical tensions rising, with inflation proving stickier than expected, and with central banks signaling slower rate cuts, institutional allocators are shifting playbooks. They're rotating out of speculative growth into proven stores of value. They're rotating out of code and into atoms, and the data confirms it. Bitcoin ETF outflows totaling $4.57 billion in November, and December represent institutional adoption reversing. That's not retail, that's Goldman Sachs, that's BlackRock clients, that's Morgan Stanley. And where is that capital going? Some are rotating into Ethereum, some into stablecoins. But a meaningful portion, the portion we're tracking through physical market premiums and inventory data, is rotating into gold and silver. We know this because gold just hit $4,188, up over 70% from where it started in 2025. We know this because silver is at all-time highs. And we know this because physical premiums are at levels not seen since the 2020 COVID panic. Now let's talk about China, because you cannot understand the silver market without understanding Shanghai. While Western media focuses on Bitcoin price charts and Elon Musk tweets, China is quietly executing the largest accumulation of physical silver in history. The Shanghai Gold Exchange has seen registered silver inventory decline by over 80 tons in recent months. That's nearly 3 million ounces withdrawn and moved into private hands. When inventory leaves the exchange, it's not coming back. It's being locked away by industrial users, by wealthy families, and by state-connected entities. But here's the terrifying part. The price of silver in Shanghai trades at a significant premium to New York. While the COMEX says 103, physical transactions in Shanghai settle closer to 110. That's a $7 spread. In a functioning global market, that spread shouldn't exist. Arbitrage traders should buy silver in New York, ship to Shanghai, sell for risk-free profit, but they can't. Why? Because there's not enough physical metal in New York to satisfy demand in Shanghai. The vaults are running dry, refiners can't keep up. And China is bidding up the price because they need metal for solar panel production, which accounts for 80% of global supply. This creates a feedback loop. As the premium in Shanghai widens, more silver flows east. As more flows east, Western supply shrinks. As supply shrinks, Western premiums rise. And as premiums rise, investors realize the paper price on COMEX is fake. This is exactly what happened in palladium in 2020. Paper price said one thing, the physical market said another. Eventually, the paper broke. Contracts settled in cash. Investors who thought they owned metal discovered they owned nothing. Physical price went vertical. Silver is on the exact same path. The only difference is scale. When it breaks, when paper decouples from physical, the repricing won't be tens of percent. It will be multiples. In Bitcoin, the asset that was supposed to protect you from this monetary chaos is proving it cannot. Bitcoin was supposed to be digital gold, scarce, portable, unseizable. In theory, it is. But theory doesn't matter when institutional money is exiting. Theory doesn't matter when ETFs are in freefall. What matters is price, and price is the ultimate truth teller. Bitcoin is down 29% from its peak. Silver is up 155% in a year. That's not a small divergence. That's a complete role reversal. For 15 years, Bitcoin evangelists told you digital scarcity would replace physical scarcity. That code would replace atoms. That millennials would choose Bitcoin over gold and silver because it's easier to store and transfer. And for a while, that narrative worked. Bitcoin went from pennies to $126,000. It created more millionaires than any asset in history. But now, in the face of real macro stress, in the face of geopolitical uncertainty, in the face of institutional profit-taking, the narrative is cracking. Because at the end of the day, Bitcoin is code. Code can be changed. Code can be forked. Code requires electricity, internet, and infrastructure. But silver? Silver is element 47 on the periodic table. It cannot be forked. It cannot be hacked. It doesn't require power or the internet. It just exists. And in a world where trust in institutions is collapsing, where central banks are trapped between inflation and recession, where governments print money to fund deficits, the oldest form of money is proving most resilient. Let me give you a thought experiment. Imagine you're a billionaire. You have $500 million to allocate for 20 years. Your choices are Bitcoin or physical silver. Bitcoin offers portability. You can store $1 billion on a hardware wallet, cross borders with it, send it anywhere in minutes. But Bitcoin requires the internet, requires miners, requires developers, requires governments to not ban it, requires institutions to keep buying ETFs. And right now, every single one of those pillars is under stress. Now consider silver. It's heavy, bulky. You need a vault for $500 million worth. Security, insurance. But once you have it, it's yours. No counterparty risk, no internet required, no government can confiscate it remotely, no developer can change the code. It just sits there, immune to digital chaos, preserving purchasing power like it has for 5,000 years. Which would you choose? And more importantly, which are billionaires actually choosing right now? The on-chain data gives the answer. They're choosing to sell Bitcoin. They're choosing to rotate into physical assets. They're choosing atoms over bits. This rotation is accelerating. People who understand markets, who understand history, who understand human psychology, know what comes next. Every major empire has debased its currency. Rome with the denarius, Weimar with the papier mark, Zimbabwe with their dollar. The United States is doing it now with the Federal Reserve's balance sheet still over $7 trillion, despite quantitative tightening talk. When currencies are debased, when governments print faster than economies grow, the value of money declines. People who hold tangible assets, land, commodities, precious metals, preserve wealth. People who hold paper promises, cash, bonds, or yes, even Bitcoin, watch purchasing power evaporate. So where does this leave us? If you're holding Bitcoin, ask yourself a hard question. Are you holding because you believe in the long-term vision of digital money, or because you're afraid of selling at a loss? If it's the former, if you genuinely believe Bitcoin will recover and go to 200,000, you should be accumulating every dip. But if you're holding out of fear, out of hope the price comes back so you can break even, you're not an investor, you're a hostage. Here's reality. On-chain data, ETF flows, whale selling, institutional rotation all point to more downside, not necessarily to zero. If you're not prepared to hold through a 40-50% drawdown, reduce position now while you can. But if you sell Bitcoin, what do you buy? Cash is being debased at 4% or more annually. Bonds yield less than inflation. Stocks are at highs while earnings slow. Real estate is overvalued. The answer for increasing allocators is physical silver. Not because it will make you rich overnight, but because it offers something Bitcoin cannot. Certainty, you can hold it, store it, verify it, and sell it without internet, without a brokerage, without a bank. In a world where trust is the scarcest commodity, that certainty is priceless. But understand this, buying silver isn't like buying Bitcoin. Bitcoin is liquid. Buy and sell 24/7 with a click. Silver is physical, takes time to acquire, time to liquidate. Spreads are wider, premiums fluctuate. If you're not careful, you'll pay 20% over spot just to get metal. So if you make this rotation, be strategic. Buy from reputable dealers. Verify authenticity. Except this is a long-term hold, not a trade. Because here's what most don't understand about silver. It's not like Bitcoin where you check the price 100 times a day. Silver is boring, sits in your safe, doesn't notify you, doesn't send alerts, just exists, quietly preserving wealth while the world goes insane. And in 2026, with everything happening, geopolitical tensions, monetary chaos, institutional panic, that boring, steady, physical presence might be the smartest thing you ever bought. Now, I want to be absolutely clear. This is not financial advice. I'm not telling you to sell all Bitcoin and buy silver. I'm not saying Bitcoin goes to 0 or silver goes to 500. What I am telling you is there's a rotation happening. A massive, undeniable, on-chain provable rotation from digital assets into physical metals. If you ignore this rotation, if you dismiss it as noise or fear or manipulation, you're going to wake up 6 months from now wondering why your portfolio is down 40%, while silver investors are up 100%. The data is the data. On-chain metrics don't lie. ETF flows don't lie. Whale wallets don't lie. And right now, all of them are screaming the same message. Smart money is exiting Bitcoin. And it's rotating into silver. The question is, are you going to follow the smart money or fight the trend and hope you're right? Because hope is not a strategy. Hope is what retail clings to when down 50% and won't admit mistakes. Professional allocators don't hope. They adjust. They reposition. They follow data. And the data right now is crystal clear. The Bitcoin crash is fueling the silver rocket. People who understand this, who position correctly, will emerge from 2026 wealthier. But people who cling to the digital gold narrative, who refuse to acknowledge the macro shift, who keep buying dips as institutional money floods exits, they'll learn an expensive lesson about the difference between theory and reality. This is a great rotation. Capital moving from speculation to safety, from leverage to liquidity, from code to collateral. It's happening now, in real time, on the blockchain, in ETF flows and Shanghai vaults. You can choose to see it or choose to ignore it, but you cannot choose to avoid the consequences. The window to act is narrowing. Every day, more silver leaves COMEX vaults. Every day, more Bitcoin whales sell. Every day, the spread between digital promises and physical reality grows wider. When that gap becomes too large, when paper can no longer pretend to represent physical truth, the system breaks. Price teleports. People holding the wrong asset watch wealth vanish while silver holders watch purchasing power multiply. This is not fear-mongering. This is pattern recognition. This is what happens when speculation meets reality, when narratives meet fundamentals, when hope meets math. And in 2026, the math is winning. Silver is winning. Bitcoin, the asset that was supposed to replace gold, is proving you cannot code your way out of a bank run on trust. The rotation is here. The evidence is on-chain. What are you going to do about it?